Hello, everyone. Today, in our course, The Development of Digital Currencies, we will cover Section 5.2, the significance of digital currencies regulation. With the global expansion of digital currencies, the decentralized nature of their underlying technology creates, with the traditional regulatory models of the financial system, a profound conflict. Regulation is not about suppressing innovation, but is a necessary safeguard for building a sustainable ecosystem. This section will systematically explain the core value of digital currency regulation and reveal its irreplaceable role in balancing technological revolution and systemic risk. In this section, we will cover the following topics. Upon completing this section, you will be able to 1. Demonstrate the transmission mechanism through which regulation suppresses systemic financial risk. 2. Analyze governance pathways for addressing cross-border regulatory arbitrage. 3. Evaluate the critical role of technical security standards in protecting user assets. First, let's learn about the maintenance of financial system stability, which is the primary goal of digital currencies regulation. Maintaining financial system stability mainly involves three aspects. 1. Curbing the bank disintermediation effect. When central bank digital currency, CBDC, replaces commercial bank deposits on a large scale, it directly weakens banks' credit creation capacity. Bank for International Settlements (BIS) models show that a CBDC penetration rate exceeding 25% could lead to a contraction of bank interest margins by more than 50 basis points. Regulation uses tools like setting personal holding limits, for example, wallet limit of the digital yuan up to 100,000, and tiered interest rate designs, zero interest for small amounts, negative interest for large amounts, to effectively control the speed of deposit migration and maintain credit market stability. 2. Blocking abnormal cross-border capital flows. A 2024 International Monetary Fund (IMF) report indicated that unregulated digital dollars could trigger capital flight in emerging markets. The regulation requires establishing firewall mechanisms, warning system of currency substitution, monitoring in real time the share of sovereign digital currencies in foreign exchange reserves, pilots of sandbox regulatory, limiting the penetration rate of foreign CBDC in domestic payment scenarios. For example, the EU requires non-euro CBDC single transactions to be below 1,000 euros. 3. Ensuring the effectiveness of monetary policy transmission. Digital currencies could weaken the capability of the central bank to adjust interest rates. For instance, the zero lower bound on nominal interest rates for CBDC can hinder the implementation of negative interest rate policies. The Sveriges Riksbank introduced into its e-krona design a technical deduction mechanism. When the policy rate is negative, wallet balances are automatically reduced proportionally. This solution relies on the enforcement power of the regulatory framework. After understanding financial system stability, let's next explore how to build a legal compliance framework to resolve sovereign conflicts and regulatory vacuums. Building a legal compliance framework mainly involves three aspects. 1. Establishing jurisdictional standards. Disputes involving Bitcoin in cross-border payments often face difficulties in legal application. The 2023 FTX bankruptcy case involved 1.2 million creditors globally. Due to differences in how countries define digital currency property rights, China's Civil Code, Article 127, defines it as online virtual property, while some US states classify it as money. The liquidation process remains unfinished. Regulatory efforts need to promote one unified rules for determining ownership, clarifying that the holder of the private key is the legal owner, cross-border judicial collaboration mechanisms, establishing multinational joint liquidation courts. 2. Combating new types of financial crime. 1. Decentralized finance, becoming a hotbed for money laundering. Mixer Technology Challenge, Tornado Cash, facilitated over $7 billion in money laundering in 2022, leading the U.S. Treasury to sanction its protocol address. For example, 0x12D-C4F for the first time. 2. Concealment of algorithmic crime. In 2024, a transnational criminal group used smart contracts to automatically transfer illicit funds, rendering traditional anti-money laundering (AML) systems ineffective. Regulatory response. Mandatory on-chain tracing standards, requiring all trading platforms to integrate Chainalysis tracking tools. DeFi protocol liability. Look-through. The EU's funds transfer regulation stipulates that even decentralized platforms must perform KYC obligations. 3. Endowing smart contracts with legal validity. The DAO incident exposed the legal vacuum concerning code vulnerabilities. Innovative regulatory paths include 1. On-chain arbitration mechanisms. Ethereum added the Claros court system, where arbitrators execute forks for disputed contracts. 2. Mandatory code audits. Singapore requires all financial smart contracts to obtain 30K security certification. After discussing the legal compliance framework, let's study how to ensure technical security and user rights, which is key to building the foundation of trust in digital currencies. Ensuring technical security and user rights mainly involves 3 aspects. 1. Defending against quantum computing threats. The elliptic curve digital signature algorithm, ICDSA, relied upon by existing digital currencies, can be broken by Shor algorithm. Regulation promotes technological upgrades. 1. Timetable of post-quantum algorithm migration. US NIST requires digital currency systems to transition to lattice-based encryption by 2030. 2. Security standards of dual offline payment. China's digital yuan hardware wallets mandatorily use the SM9 National Cryptographic Algorithm for end-to-end encryption. 2. Resolving the privacy protection paradox. Regulation must balance anonymity and controllability. 1. CBDC tiered privacy design. Sweden's eKrona uses blind signature technology for anonymity in small transactions, while large transactions are identity linked. 2. Regulatory interface of zero-knowledge proof, allowing law enforcement agencies with a court order to access specific transaction flows to avoid comprehensive surveillance. 3. Bridging the digital divide. Approximately 230 million older adults globally are excluded from the digital currency system due to technical barriers. Regulatory responses. 1. Mandatory offline payment coverage. India's digital rupee requires all POS terminals to support NFC offline transactions. Key escrow relief system. Japan allows banks to custody user private keys when biometric authentication fails. Finally, let's explore how to promote international collaboration and standard unification to address borderless financial challenges. This is the global dimension of digital currency regulation. 1. Establishing regulatory information sharing networks. In 2024, the IMF led the construction of a global CBDC data exchange platform covering 3 core data types: real-time monitoring of cross-border CBDC flows, shared blacklists of mixer protocols, early warnings on quantum computing research progress. 2. Coordinating mutual recognition of technical standards. Avoid regulatory fragmentation, leading to arbitrage. Interoperability protocols. The International Organization for Standardization, ISO, published the Central Bank Digital Currency System Architecture, Standard ISO 20022-8. Carbon footprint constraints. The EU excludes Bitcoin POW mining from its sustainable finance taxonomy, pushing for consensus mechanism upgrades. Class. Today, we systematically study the significance of digital currencies regulation. We conducted an in-depth exploration from 4 aspects: maintaining financial system stability, building a legal compliance framework, ensuring technical security and user rights, and promoting international collaboration and standard unification. Hope that you can apply the knowledge gained today to future fintech practices, maintaining an open attitude towards technological innovation, while remembering the bottom-line thinking of risk, prevention, and control. The future development of digital currencies requires the wisdom and commitment of every one of us. Finally, please complete the following exercises. That's the end of today's lesson. See you next time.